Yo, what's up everybody? It is Friday. Yeah, July 1st. All right. So we had a nice up day in the market today, as I told you guys, as I was expecting. I hope some of you made some money on my recommendation. Today was first of the month, government disbursement day. So this is the first of every month. You get all your big payments. You get your Medicare, Medicaid, military pay, veterans benefits, disability, all this stuff. So we had probably over 100 billion day in terms of net, total government spending or the leading flows of spending. Over 100 billion. I said, yesterday in my video, I said now there's basically 5 times a month that we're going to see positive flows. The rest of those days, the other 15 business days out of the month, you're going to see net drains. But those 5 days, you could play them, especially the first of the month when you have, this is the biggest disbursement day of the month. So we had a nice upward move in stocks. I said that was going to happen. Bonds too. We saw more yield decline. We got, actually the 10-year got down to, I think the lowest I saw was 279, and it popped up a little bit. I think we can see some follow through into early next week. Monday obviously is July 4th holiday, so the market's closed, but Tuesday I think we could see some follow through that. At least that has been the pattern on these positive liquidity flow days. After that, we're going to get back into, this kind of sluggish fiscal, with most days being fiscal drain, being liquidity drain. We ended up the month of June with a very strong, actually it was a very strong leading flow of 573 billion. That was up from 548 billion in May. That's a really good leading flow. I mean, you're talking about almost 600 billion. But the problem is, the government's taxing most of that away as it is spending it. So, I mean, we ended up with a deficit for the month of 54 billion. So we had an 86 billion deficit in May and a 54 billion deficit in June. So you add those two together, that's 140 billion, net addition to the financial balances of the economy. But we had a 324 billion drain because the government ran a 324 billion drain in April. So we're still not even halfway back to what was drained out in April. Right? I mean, April was 324 billion surplus, so that's a drain from the economy of 324 billion. And then you had 2 months, May and June, of what I just say, 140 billion. So we're not even halfway back to recovering that April drain. So this is why the economy is having a problem. So again, I think the rally will continue early next week, and then I think we start to see some trouble in the market. The good news is with bond yields coming down, and I see now that some of the Fed monetary policy expectation is starting to moderate. If you look at Fed fund futures, if you look at that, the CME has the Fed Watch tool. If you Google Fed Watch tool, it shows you, based on where Fed fund futures are trading, what the probability is for Fed policy at the upcoming meeting. So we're still looking at a 75 basis point expectation, 75 basis point rate hike expectation for the July 27th meeting. However, I think that's all the way down to, if I'm not mistaken, that might be like less than 80%. Way less than 80%. I have to look at it again, but it might be something like 70, 72 or 73%. That has come way down because last week it was like 95%. And then the September rate hike expectation right now is for a 50 basis point hike, and then in November is for a 25 basis point, then 25 basis point in December, And then I forget where it goes. All I know is that by the market is forecasting by June 2023 we'll get our first rate cut. So rate cuts are starting to be priced in, a year out. But again, I don't pay a lot of attention to that other than to, be cognizant of how people, that's their only focus. That's the only thing they look at is monetary policy. So I have to be aware of that because that affects behavior. So I look at that. But for me personally, my understanding of it, or I should say that the reality of it, is not just my understanding, is that, like I've said so many times, rate adjustments or price adjustments, they're also, they can equate to, they are fiscal operations too. I mean, when rates go up, that necessarily means the government is going to be paying more interest into the economy. The Fed's going to be paying more interest. We know this. They pay interest on reserves as they raise the rates. They're literally raising the rates on themselves. They're literally causing a transfer of their income to the economy. I did a bunch of videos on this. You should go back and listen to them if you're not familiar with the comments that I've made on this stuff in the past. So that's how I look at it. But for me, the main thing is what's happening with the fiscal. One little disturbing trend I saw in the fiscal, and I sent out a chart to my subscribers, is that there has been a rising trend line. If you look at average daily Treasury withdrawals, in other words, average daily spending by the government, that has been on a slowly rising uptrend since the beginning of October. In other words, since the beginning of the fiscal year 2022. That trend line now is breaking down. I mean, we just had a penetration below that trend line. What does it mean? I take it to mean that we're starting to see a deceleration in the fiscal flows. And, that would be the first time. I mean, we know there's been a deceleration year over year. That's clear because last year we had a lot of the COVID stimulus. But this year, just looking at it on its own, it has been trending higher. We've had, there's been money for the Ukraine military operation, all this stuff. But for the first time, I'm seeing this trend line, which again has been in place since October. We just breached that trend line to the downside. Obviously, today's numbers with 100 billion first of the month, it's going to pop it back up over that trend line. But it looks like now we are ratcheting down to a slower pace of fiscal support. In the big picture, let me go over this again. We are in a recession. We're going to see a negative print for second quarter GDP. That's almost a certainty. That would qualify for the accepted definition of a recession, which is 2 quarters of negative growth. The good news is interest rates are coming down, as I mentioned. We'll probably see some relief on the inflation side, although I'm not so sure on the energy side because with all the Russian sanctions still in place, and that's going to have a long-term effect, but we might see some relief there. We did see a pullback this week in oil prices to some extent. However, like I say every week, I check this every week, oil producers have been net long oil futures since last November, and I don't see any let up. As a matter of fact, in the most recent data from a week ago, and I didn't check today's CFTC, but it's out now. I want to see what that is, but they're still long. Banking data, let me mention, I just took a look at the banking data that was for the week ending July 22nd. Another big increase in loans, yes, across the board. Loans are up like 50, I believe it was like 52 or 53 billion in the week. We had increase in commercial and industrial loans. We had increase in real estate loans. We had increase in a big increase in consumer loans. You may recall, I don't know if it was the last video or a couple of videos I did prior to this one, I said I was a little bit concerned because in the last banking data, which was through the week ending June 15th, we saw the smallest increase in consumer loans in 6 months. And I said that might be the first sign of, consumers, households pulling in their spending. But I said I can't really make a judgment call on that based on 1 week's worth of data. But now I just saw the new data. Boom, a big increase in consumer loans. That was credit card loans. Automobile loans popped up again. So it doesn't look like it looks like it was, I was calling the premature death of the consumer. So that looks good. And that would be, that's a bullish economic development. All right, or it continues to be a bullish economic development, so I want to keep an eye on that. All in all, it's about the flows. It's good to see loan growth, but it is about the flows, and that still, to me, it poses a challenge. If we, as I said, if we are in a recession, and we are, the thing to watch now is going to be the labor market. Because if you get a pickup in unemployment and job loss, you're going to also get a pickup in the automatic stabilizers, unemployment insurance, that stuff. And when the automatic stabilizers kick in and interest rates coming down, that's going to be the bottom of the market. We get the market does rally in the middle or the midst of a recession. This is classic, a classic pattern of how the market behaves. Just like it peaks out before we see the actual recession. So, but I just checked again the numbers on average daily unemployment benefits being paid out by the government, and I did mention that started to trend higher, but it just turned around again and started to head back down. So, maybe my call on the weakness in the labor market, maybe that's a little bit premature now too. Anyway, that's it for today. Good rally, which I called. I said you got to be long going into Friday. I'm saying that next week, probably Tuesday, also going to see some pop, and then I think we could see some pullback. So enjoy the weekend, and if I don't get to make another video by July 4th, eat those hot dogs. Have a nice and safe July 4th, everybody. Bye.